Let me tell you about a version of yourself you probably recognize. You've just read something about risk to reward. Maybe it was a trading book, maybe a YouTube video, maybe someone in a Discord server who seemed like they knew what they were talking about. And the message was clear. Aim for at least 2:1. Better yet, 3:1. Only take trades where you risk $1 to make 3. That way, even if you're wrong more than you're right, you still come out ahead. The math is clean. The logic sounds airtight. So you take that rule into the market with you. And you start looking for 3:1 setup. And here's where it quietly starts to fall apart. You find a setup. It looks good. Your entry is clean, your stop loss makes sense, and you project the move forward. But the nearest logical target only gives you 1.5:1. So you extend the target. You push it out to where a 3:1 would sit. You tell yourself the price could get there. It's possible. And you take the trade. Sometimes it works. Most of the time the price moves in your direction, gets close to your target, and then turns around. You watch it retrace all the way back through your entry and stop you out. What had been a winning trade on a 1.5:1 target becomes a full loss chasing a 3:1 dream. Or this version. You wait. You wait for a setup that genuinely offers 3:1. And you wait. And the market moves without you. Clean setups appear, valid entries you can see clearly, but the target isn't far enough away to qualify. So you sit on your hands and watch opportunity after opportunity pass. Then finally, after hours of waiting, something appears that looks like it might reach your 3:1. You're a little desperate by now. A little bored. A little frustrated from watching the market move without you. So you take it. And it's not actually as clean as the setups you passed on. But the numbers work on paper, so you enter. You already know how that ends. This is the trap that almost nobody talks about honestly. The 3:1 risk-reward rule sounds mathematically bulletproof. And in a spreadsheet it is. But trading doesn't happen in a spreadsheet. It happens in real time, with real emotions, in a market that does not care about your target levels. Let's slow down and actually look at what high risk-reward ratios cost the average retail trader. Not in theory. In practice, when you chase a 3:1 target, you are asking the market to travel a significant distance in your direction before it's allowed to turn around. That's a big ask. Markets don't move in straight lines. They push and pull. They test levels. They shake out positions. The further your target, the more of that noise your trade has to survive. And most retail traders, if they are being completely honest, do not have the psychological constitution to hold a trade through a deep retracement while it grinds its way toward a distant target. You've experienced this. The trade moves into profit. You're up 1R. You're up 1.5R. And then it pulls back. It drops back to your entry. Your profit evaporates, and every instinct in your body is screaming at you to close it, to protect yourself, to take something rather than watch it turn into a loss. So you close it, break even at best, and then you watch it push all the way to your 3:1 target without you on it. That experience does something to you. It erodes your ability to hold trades. It makes you gun-shy. It trains your finger to close early. And now your strategy, designed around a 3:1 reward, is being executed by someone who closes at 1:1 or break-even because they've been burned too many times watching profits disappear. The ratio on paper means nothing if the human executing it can't actually hold the trade. Now let's talk about 1:1. And I want you to genuinely consider this before you dismiss it, because I know what the reaction is. I've had it myself. 1-to-1 sounds like it barely covers the spread. It sounds like there's no margin for error. It sounds like you'd need an impossibly high win rate just to break even. But here's what actually changes when you trade 1:1 seriously. Your targets become realistic. Instead of projecting a move to some distant level the market may never reach, you're targeting the next logical area of interest, the next structure level, the next area where price has shown it react. You're not hoping. You're identifying. There's a fundamental difference between those two things, and it shows up in your win rate. Your entries tighten. When your target is closer, you naturally become more precise about where you get in. Because a bad entry on a 1:1 trade is immediately punishing, there's no room for the trade to wander before it needs to move in your direction. This forces a discipline that sloppy entries on wide reward targets don't. Your holding time shrinks. Trades resolve faster. You're not sitting in a position for days hoping it slowly creeps toward a distant target. You enter, the market either validates your thesis quickly or it doesn't, and you move on. That speed of resolution keeps your psychology cleaner. You're not dragging the emotional weight of open trades through your entire day. And your win rate goes up. Not because you got better at reading the market overnight, but because you stopped asking the market to do more than it reasonably tends to do. Here's what nobody does but everyone should. Take your last 50 trades. Go back through your journal, and if you don't have a journal, that's a different conversation, and look at how far your winning trades actually moved before they turned around. Not where you hoped they'd go. Where they actually went before price reversed. For most retail traders, that number is much closer to 1:1 than 2:1 or 3:1. The market was willing to give you a 1:1 on most of those trades, but you were aiming for more. So you either held too long and gave it back, or you moved your target and got stopped out, or you passed on the trade entirely because it didn't offer enough reward on paper. You've been leaving money on the table trying to find more money on the table. There's a concept I think about a lot, and it's this: theoretical edge versus executable edge. Your strategy might have a theoretical edge at 3:1 risk-reward. But if you cannot execute that strategy the way it was designed, because the targets are too far, the hold times are too long, the psychological pressure is too high, then your theoretical edge is worthless. What matters is the edge you can actually execute. Consistently. Under real conditions with real emotions and real money on the line. For most retail traders, 1:1 executed with discipline and a solid win rate is a higher executable edge than 3:1 executed poorly. Let me give you the numbers on this so it's completely clear. A trader with a 3:1 reward target only needs to be right 25% of the time to break even. That sounds attractive. But what's a realistic win rate at 3:1? For a retail trader targeting those distant levels, extending targets to make the math work, holding through deep retracements while their emotions are screaming at them? In practice, it tends to be somewhere around 30 to 40% on a good strategy. Let's say 35. That gives you a positive expectancy. On paper, it works. Now, a trader targeting 1:1 needs to be right more than 50% of the time to break even. But what's a realistic win rate at 1:1 when the targets are near logical structure, the entries are disciplined, and the trader isn't being psychologically destroyed by watching profits disappear? In practice, it's often 55 to 65%. Let's say 60. Run both of those. The theoretical 3:1 at 35% win rate and the 1:1 at 60% win rate. Over 100 trades with the same risk per trade. The numbers are closer than you think. And when you factor in the actual execution reality, missed trades, premature closes, extended targets that don't hit, the 1:1 trader often comes out ahead. Not because 1:1 is mathematically superior. Because it's humanly executable in a way that 3:1 often isn't. There's a version of you that can trade 3:1 effectively. That version is experienced, psychologically seasoned, extremely disciplined, and operating from a place of genuine detachment from outcome. That version can hold a trade through a 50% retracement without flinching. That version doesn't move targets, doesn't close early, doesn't let emotion touch execution. That version exists, but it's built over years. And it's not built by forcing 3:1 on a developing trader who doesn't yet have the emotional infrastructure to support it. It's built by trading in a way that keeps you in the game, keeps your psychology intact, and slowly develops your ability to hold through discomfort as you gain confidence from consistent execution. You build that by starting somewhere executable. For most retail traders, that place is 1:1. I'm not saying never trade 3:1. I'm saying know the difference between a rule that looks good in a backtest and a rule you can actually live inside the market. The best risk-reward ratio is not the one that sounds most impressive. It's the one that you can execute with discipline, sustain over hundreds of trades, and actually walk away from sessions feeling like you made decisions based on logic rather than hope. The market doesn't reward the most ambitious target. It rewards the most consistent execution. And you cannot execute consistently when you're constantly asking more of the trade than the trade can realistically give you. Start where you can win. Build from there. That's the whole thing.